So basically, what started as a small question about press arrangements has now become another window into India-US diplomacy. And while politicians debate questions, another institution is making a very different decision about money. We are talking about the Reserve Bank of India here. Now we are talking about the most important stories for Indians living abroad. The Reserve Bank of India has brought forward the deadline for its foreign currency swap facility. The earlier timeline extended to the end of September. The new cutoff is August 31st, 2026. Now, you know why should NRIs care? Because the policy has helped Indian banks offer unusually attractive rate on foreign currency deposit. And the number that is being discussed, significant. Foreign currency inflow into Indian banks have surged with more than $65 billion reportedly mobilized through these particular channels. Well, the basic idea is simple. You have dollars, you do not want to convert them into rupees, you want to keep the money in foreign currency. And at the same time, you want a competitive return too. Ladies and gentlemen, that is where FCNR, foreign currency non-resident deposit, come in. And under the current policy environment, some banks have been offering elevated rates here. Certain structures have also allowed sophisticated investors to use the foreign currency deposit just as part of a broader liquidity here. But here is where we need to slow down. High returns do not mean zero risk. There are banking conditions, there are lock-in period, there are tax rules, there are reporting obligation. And for the US taxpayers, the whole story becomes even more complicated. A foreign account does not disappear from your tax obligation simply because India does not tax the interest in the same way. US tax resident may have reporting requirement for the foreign financial account and foreign income. FBAR rules that can apply. FATCA reporting can apply depending on the person's circumstances further. And yes, this is exactly why cross-border finance, it is so different from the ordinary investing. You cannot look only at the headline rate. You have to calculate the after-tax return. In fact, you have to understand the reporting requirement. You have to know the maturity period. And ladies and gentlemen, lastly, you have to consider what happens if your residence status that changes. August 31st, 2026. Again, it's a deadline that becomes important for people who are considering these products. But remember here, a deadline creates urgency. It should not eliminate the dual diligence here. Ladies and gentlemen, speak to the bank, understand the exact product, check the applicable tax rule in your country of residence, and calculate the real return after tax and compliance cost. Because let's be honest here, when money, it crosses the border, the paperwork travels with it.